You didn't get enough time to relax? Well, we've only got 3 sections left, so I'm thinking we'll probably be done anywhere between 4 and 5 o'clock. Of course, after we're done, if you guys have any questions that you're thinking of, I'm more than happy to go back to a particular section to review it. But I think we'll probably be done with the slides anywhere between 4 and 5 o'clock. Just to kind of give you guys a gauge of or an idea of when we'll be done, so you can plan the rest of your evening. But all right, everybody's back. We'll get started here with trade setups. Okay, now, as we've already been discussing here over the last 2 days, all setups, right, we can see these setups in any time frame. Really, whichever one we decide to look at. As I said, we're going to use the 5-minute for our bias, and then we'll move to a lower time frame if needed. We'll get our bias of trend from the 5, and we'll also be looking for patterns from the 5, trade setups from the 5, and again, if we feel need be, we'll go down to the lower time frames. And as we can, if we can add to these trade setups different amplifiers such as pivot lines and internals, along with support, resistance, bottoming tails, topping tails, right, this is going to increase the odds. So we're going to use everything that we've learned, and of course some common sense, to make our decisions. They may or may not form exactly as we see in the following examples, because every day has its nuances, but it's the general idea of what we're looking for, right? All trade setups, as we mentioned on the very first day, the odds of a similar pattern happening and repeating the exact same way are extremely low. But we look for these patterns because they have there's the likelihood for them to repeat a similar outcome, or it gives us a bias as to what we expect to happen. Right? We expect prices to move in a PBS. We expect, right? Of course, it'll form in different ways, but we expect it to result in an advance in price. So again, we're looking for these patterns to set up, these trade setups to form, but we have to realize that they're not going to form exactly as these examples show. There are going to be some variations, but it's the general idea. PBS, we have a pullback to support in an uptrend, right? Does it have to be exactly 3 to 5 bars? No. Why? Because what if we're looking at a 2-minute chart and we get a 2-bar pullback and a bottoming tail? On a smaller time frame, we will see that 3 to 5 bar pullback. So we can't be so strict as to say, well, if this is only 1 or 2 bars retracing and it's into support, I can't buy it because it's not exactly 3 to 5 bars down. Right? That's where some of the common sense comes in. Right? And we have to say, well, it's not exactly 3 to 5 bars, but it's pulled back, it's at support, and I have this bottoming tail telling me buyers are stepping up, and the internals are bullish. So I don't want to be ignoring that message. So setups with the trend are going to be PBS, PSS, 180 reversals, 1, 2, 3 continuation, or a 1, 2, 3, 4 continuation. We also have the higher high pattern at major resistance or lower low at major support. Those are the bull or bear flag patterns. Setups within a sideways or transitional trend for us to consider. Breakouts or breakdowns with a shakeout. Right? That's key. Prior to the breakout, there was an attempt to move lower that failed, and we came back up into the base and consolidated. That's key. Breakouts or breakdowns with a wide range bar igniting. Measured move pattern. triple top or triple bottom. These are all patterns that we can see within a sideways or transitional trend. Counter trend setups, right? M and W bottoms and tops, or tops and bottoms. Climactic buy setup with a W in a lower time frame. Climactic sell with an M top in a lower time frame. A new day's low or high reversal. We could even say that setups with the trend, right? We could even say M and W formations, right? We could even add M and W's with the trend. Right? So they can be used with the trend or against. Now, to define the trend, as we already said, we're going to use the 5-minute, right? And we're going to use the color of the 13MA as a guide. But we're going to always base the bias on whether or not we're trending higher or trending lower based on the rules of support and resistance. Trade setups will be taken from the 5-minute time frame or any time frame below it, as long as it's in the same direction of that 5-minute. Right? The rule, though, for counter trend setups is that they can be traded when the 5 minutes become climactic or extended. Right? That is when we can take counter trend setups. So this is the beginning stages of developing a trading plan right here. Right? This slide. Here are the trade setups we're going to take. Here's the definition of how we're going to analyze the trend and what the requirements are for when we're going to take these trade setups. Right? So this is the beginning of formulating a trading plan. Okay? And that is essentially what this course is all about. We're basically just building a trading plan. So PBS, right? The trend is clearly up, right? We have an end of day base here. We gap up above it, so we've got support below. We gap to the top of this next area, and we consolidate. We get a bullish bar right here, closed on its high, which led to the break higher. So we've got buyers in control. Prices pull back into this 13MA, and then they begin to consolidate sideways, creating a new reference point of support. So we get the pullback, it forms a double bottom, that's what DB, double bottom bars, if no support is nearby. We get the bullish reversal, bottoming tail, and inside bar, signaling a move higher. So we buy the PBS. And then we just manage it based on our rules. Why was this PBS questionable right here?
What happened?
This one right here, you got why was this PBS questionable? The one the arrow's pointing to. Right, we've got this topping tail to the left. It was a failure to move higher, right? And a retracement of that breakout bar. Yes. So not only did you have a little minor failure to move up, we completely retraced that entire breakout bar. Right? As we said, a return to the breakout point is negative. That's not what we want to see. So this was more questionable. But as we started to go sideways here, buyers were continuing to step up at major support, and we formed this double bottom. Prices then began to move higher. And then again, they pulled back slightly. Very bullish angle of retracement here, turning into just really a consolidation, and then another breakout. And look at the volume. Look at the volume we got with that breakout. And prices really could not continue to move higher. So this is beginning to increase supply. PSS. The trend is clearly down. So we had to have overcome a level 2 pivot at a minimum. in order to change the uptrend down into a downtrend. So we're in a downtrend, right? We have this weakness, we gap down lower, retracement into the gap fill area, and we get this double top. Here was the first bearish changing of the guard. It stalled here a moment, came back up, retest, topping tail, closed on its low. So here's our PSS, pristine sell setup. We look to short it under the topping tail bar's low. In here, stop goes above the high, and then again we just manage based on our rules. Pointed out, but bottoming tail, new low reversal. Assuming volume spike in a climactic move means opposition. Well, not necessarily. It may, but it could just mean that there's the greed is increasing. Everyone's becoming fearful of missing the move. So you could have a bunch of traders loading up or jumping in. And they may just be hitting a market order to get filled. So it could be that it's happening on buying, and then it just has no follow through. Right? So that means on the very next bar, sellers are stepping up more aggressively, and there are also those traders taking profit. So we get the PSS, fluid move down. This breakdown comes back up with this move to a new low, comes back up, forms a bottoming tail. Demand is increasing. We then get a bullish move up here above major resistance with room to move higher. So the bias now on the right-hand side of this chart is that we could possibly begin to retrace all the way back up. We have to wait and see what happens. 180 reversals. The key with these 180 reversals, go ahead, sure, I'll go back to the last slide. Well, so it depends. Sometimes I will. Like for example, if I saw this bullish bar up, I would not just short under that green bar's low. I would want to see this bearish bar form. But if this bearish bar up, or if this bullish bar closed with a large topping tail, that would be enough of a signal for me. I don't need to wait for the bearish changing of the guard. So it's okay for me to have a green bar on the close, but it would have to, the majority of the bar's range would have to be in the form of a topping tail. If it's going to close bullish like this, I then do need to see that reversal. By the break of the red bottoming tail, this here, nope, that's fine. Why is that okay? Because you've got the new low reversal, strong move up, and deep penetration into resistance, right? This bottoming tail caught traders on the wrong side. Traders tried shorting this, and it was a bearish looking bar, but then it finished with a bottoming tail. So it's fine to buy it over that bottoming tail bar's high. Perfectly fine. So with these 180 reversals, the key is that they have to have void to move lower. We violate this area of major support. We push down, close below it. Tries to stabilize. Prices try and stabilize. They turn back up. Followed by a complete 180 closing on its low. So if you didn't get on board the double top or any of the other potential entries, right, you use this 180 reversal to get on board a moving trend. And like I said, the key is that it's got void to move lower. This momentum move up left a big price void. So you get the bullish reversal here forming in an area where there's no support. It's followed by a 180 reversal. We short under the 180 bar reversal's low. And then our stop goes above the high, and we just manage it down. And really, there was no reason to get out of this position until down here, where we started to see this double bottom forming. That was the first indication that buyers were really stepping up. But what happened? It popped up into resistance, and it was quickly reversed once again. And so that became another spot where we could have gotten back on board if that did stop us out. You just have to stay objective and say, okay, trying to hold here, bullish bar up, it's got all this resistance here. What happens on the following bar? Oh, 180 reversal back down. Short it again. It's got to get moving. But again, like I said, the key with these 180 reversals is that there has to be room to move. There has to be void. The bullish continuation, the 1, 2, 3 continuation. We've got an uptrend in place. So that is the first part of this setup. We have to have a clear uptrend. We get a breakout. It's followed by an inside bar. Right? Does not break the low. It consolidates. We get another bar of consolidation. Right? We're looking to buy above these highs for the continuation of the strength. So the trigger bar, it doesn't have to happen on the third bar, right? It doesn't have to happen, but ideally it'll happen on the fourth. Right, so here's the breakout bar is the number 1 bar. Right? Then you get the second bar is number 2, and then the third bar is the continuation up. Like I said, it doesn't have to happen on the third bar. Right? It may happen on the fourth, which is fine. And it's okay if we take out that prior low by just a couple ticks and snap back up. It's all right if that happens. And then we look to enter on the continuation, looking for prices to move higher, assuming, of course, there's void to move and the larger time frame supports it. Here's a 1, 2, 3, 4 continuation. We have a weak trend. Prices are moving lower. Major resistance is right here. Prices come right up to the top of it. We get a bearish reversal bar. It begins to break lower. We start to track each bar's low, looking for an entry point. As we see this move back down and it tries to stabilize, right, when it pops up like this and comes right back in, that catches traders on the wrong side. The overall trend is down. We had an attempt to move higher through major resistance that failed, right, and we took out the bottom of this green bar. Right. Buyers try and step up once again. The topping tail signals that we overcame the first area of resistance being a prior bar's high. But we closed down on the low. Right. This is essentially, right, also what we called earlier as a money bar. So we enter short on the break under the topping tail bar's low. Stop goes over the high, and again, we manage it based on the rules. Here was another entry on the breakdown. No follow through to this bullish reversal. Continues to move lower. Bear flag. Right, the higher high pattern into major resistance. The first bearish changing of the guard, right? It doesn't have any resistance. Look, see, nothing's to the left of this here. There's no resistance. So this first attempt fails. We get a push up into major resistance, Right? That's where we then see the topping tail, then the bearish reversal, the bearish changing of the guard, which forms. Our entry is under that bearish reversal bar's low, the bearish changing of the guard. We short it under the low. The key, though, with this setup is that prices have not closed above major resistance. They come right up to it, but they do not close above it. And we don't care that this moving average is green. Why? Because we have not overcome major resistance. So the trend is still down. And those traders that are basing their decisions on moving averages, whether we're above or below, they're just going to add more fuel to this move lower once they have to stop out of those positions. And on a larger time frame, right, if this is a 2-minute, on the 5-minute we would have a more clear looking PSS. I'm just waiting for Tom's question. I don't want to go to the next slide just yet. So price on the second attempt failed to go into. You mean short on the breakdown of the low? Like that, shorting under this low? You could do that. You could wait for that to happen. But your stop has to be up here. If you were going to do that, your stop has to be up here. That's why with this setup, right, we know that we're getting in right at major resistance. So there's really not a whole lot of room for error with this. It's either going to work or it's going to stop us out. Oh, if right here, if it just consolidated right here and then broke down, yeah, that would have been okay, sure. If it formed an M top here and it started to move lower, yeah, that would have been fine to short. Nothing wrong with that, because it's that would then say that the market, the next retrace, to the left or to the right. Here? So if this formed an M top, if this moved up and retested that high from the first retracement, then yeah, that would have been fine. Yeah. If this retracement came up to retest that prior area, then yes, you could have shorted that. Well, the stop would be right above on this area right here, Dan. The stop would be just above the topping tail in what became this level 3 pivot. here we have a W bottom with the trend. I also made a little lower low. Setup still valid with close. Yep, because it never closed above it. Right? It never closed above that major resistance, which is the key. Right? It could come all the way up to it. Right? When it does that, though, we want to make sure that we're dealing with a very bearish day. That's what we want to make sure of. Also realize that with this setup, there was nothing. Yeah, closing above it would open the possibility for a more bullish move. But realize that with this setup, right, there was no shock patterns to move lower. Right? There were no breakdown failures. Right? There were no downside shakeouts. So there was really no fear. There was no increasing demand being signaled by the market. Right? Over here, though, the very bottom right, look at this. Here we have a breakdown failure taking place. Breakdown under these lows and snaps back up. So this is something that could lead to a more significant retracement. But over here, there's no shock value. There's no downside shock taking place. So that's why this slow retracement into major resistance sets up another opportunity to short. Is it somewhat conservative? Well, is it really a double bottom? It doesn't have anything potent to the left or to the right of it. There's nothing compelling that says buyers are really stepping up. It was a little bit of a retest, but there was no real strong indication that buyers stepped up aggressively. So yes, this is a reference point that we need to be aware of. Right? This is a pivot low, so we do need to respect it and expect that there's going to be buyers that step up here. But based on the overall trend being down and the fact that we came into major resistance, we should be able to trade through the bottom of that support. Okay. Now, double bottom with the trend. We have an uptrend. Prices begin to pull back. There's no support to the left here. So I would not be buying this PBS. As we begin to move up, we hit the 50% retracement, start to come back down. We then get buyers stepping up at this prior low once again. Two bottoming tails. Made a lower low as well. And snapped right back up. So our long signal comes when we break above these highs. Right? That's the long signal on the W bottom. Right? We buy it over the bullish changing of the guard. Now when we're looking at W bottoms in an uptrend and M tops in a downtrend, it's not necessary for them to have potent reversals on both sides. If they do, it's going to increase the odds, but it's not necessary. Right? When we're trading against the trend, though, right, a W bottom in a downtrend, we have to have those potent reversals. Right? But when we're with the trend, we already know that buyers are in control, so it's not necessary that we have those potent reversals on both sides. So then we get a move up, minor little pullback, bottoming tail, and continues to move higher. So again, this is an example of a market that creates new support rather than pulling all the way back. W bottom against the trend. We have a climactic move lower. Bottoming tail, which moved to a new low. We have a bottoming tail, which moved to a new low. Stabilization, pullback, potent reversal, and move above this prior pivot high. So our entry is right here, right? Above this potent reversal bar's high. Then get a strong move up, filling the void, pullback, little double bottom here. And remember, now the fact that we came up from a double bottom says that we're no longer in a downtrend. So we can buy the next pullback. And here we have a PBS and double bottom, which leads to another very nice move higher. So with these W bottoms against the trend, ideally there's also going to be support to the left, but there has to be a potent reversal, right, on one side of the formation, and then some type of breakout bar failure, breakdown bar failure, range expansion bottoming tail, or some other type of strong reversal. How would we trade it? Well, starting from the left, here we have a move up, right? Pulls back into an area of support. So this was tradable right here. Right? To take this long without seeing what's to the left, buy it above this bottoming tail bar. And then we get a nice fluid move up. This wide range bar down, I would not be looking to take the next pullback. Right? Instead, I need to see what kind of retracement sets up. Right? Here is a sell-off, though, at the end of the day. The following day, we gap down, continue to move lower, retracement, right? We short this PSS. So we can short right here, and we get a nice fluid move down. Then we get a new low reversal. Right? This bar, this bottoming tail bar, begins to create demand. It begins to establish a more significant area. Then prices try to move higher, they pull back a bit, and we get this potent bullish reversal. So we buy this bar, we buy above the high of this potent bullish reversal. Then prices advance, come up into prior resistance, they pull back, stabilization, double bottom, we buy it right here, above this bar. And then we take it up again. Topping tail signals that momentum is slowing and we want to be getting out. Prices then pull back again, and we start to again think about buying the pullback. So that's how we would have been looking to trade it. Would you sell at the MP? Which up here, after this move up and retested that resistance? I wouldn't have sold all of it. I definitely would have been looking to get out a good majority of the position at that point because it is into a reference point. But the prior bottoming action has me thinking more bullish. So yeah, I would have been taking some off. And to be perfectly honest, I don't know that I would have sat through this pullback, but I would have re-entered on this next PBS. But I would have definitely been looking to exit some of that position up there for sure. Before I go on to the next chart, I'm just going to wait for Bob's question. All right. Bottoming tail at 1020 negates that as a PSS. This bottoming tail negates this bearish bar as a PSS. Yeah, and even so, this really doesn't have any resistance to the left. So I don't look at this and really consider it a PSS. But yeah, the bottoming tail bar there definitely says that more significant demand has been established. Right? So instead of shorting this, I would have been looking possibly for a double top to form. But once we got this bullish bar closing strong like that, it said that we were going to move higher at that point. But I would have been looking to see, maybe it does form a double top. We would have been looking to see what the internals were saying as well. Right? What if we were getting a tick divergence here? Right? Price poked down to a new low, but the tick made a higher low. Right? Well, then that would have me thinking we're likely going to retrace back up as we see here. So we would also need to consider some other factors, but yeah, the bottoming tail there definitely negates this as something I'd be looking to trade. Now the new low reversal. One of the major factors that we need to have with this, and any counter trend setup for that matter, is that it has to have a climactic move. Right? We have to have that void established. That is the key to all climactic or counter trend setups. To trade against the trend, we have to have a void created in the opposite direction. So here we have, this breakdown failure, right, begins to establish demand. We try and retrace up a little bit, and then it quickly reverses back down. We get a wide range bar lower, which has many traders now thinking that we're going to continue with the prior weakness. However, the very next bar makes a new low, but closes with a bottoming tail up near the high. So our entry on this would be above that bottoming tail bar's high, and our stop would be under the low of the day. And then what we do is go into management mode. We track a prior bar's low, right, until we take one out. Right? Why would we track a prior bar's low? Because that's the first point of support. And because this is a counter trend trade, if we take out a prior bar's low, we know that supply is increasing and we don't want to stick around very long. If you're in a long position, and the trend is up, it's okay to allow a prior bar's low to be taken out and for prices to pull back, because the overall trend is up. So buyers will step up on the pullbacks. Right? But you don't want to let, in a counter trend setup, you don't want to let the bar's low get violated and see what kind of pullback happens. I always get caught short in these. What can I do to avoid it? You always get short in this. Right? You short it up here and then get caught in the new low, or you get caught shorting the new low. Well, if you're shorting up here, after you get the wide range bar down, there's absolutely no reason you should be losing money on it. Once you get this wide range bar down, you automatically have to be thinking, now I have to protect myself. I have to protect profit. So you bring your stop to just better than break even, and you even want to consider taking some profit down here as well. Right? But you have to, like I said, bring the rest of the stop or the entire stop to just better than break even. Now, why would you not want to short this new low? Odds are more likely for a reversal than a continuation. Not necessarily. Based on this wide range bar, I would have, when I see a bar like this, I'm definitely thinking we're going to move lower. But when I see the new low reversal happen and it snaps back up, my thinking begins to shift. So just by going bar by bar, my bias you can see will change from one bar to the next. And that's just simply because we've been given new information. So if you short it up here, that's fine. But when you get a bar down like this, there's no reason it should be retraced more than 50%. But yeah. But I mean, you don't want to short the new low because it's a greater than 100% retracement. Right? From this move all the way back down is a 100% retracement, and then for it to make a new low makes it a greater than 100% retracement. And as we discussed in the retracement section, whenever that happens, we know the odds are more likely for some type of reaction back up or a brief stall before then moving lower. So I don't have a problem if you were going to short this under the inside bar's low, but do not short a new low after a wide range bar down like that. Wait for either a PSS on a smaller time frame or some little mini consolidation down here and then another break lower. Right? Because this is just a greater than 100% retracement, and you've got to expect or be thinking that it's going to react the opposite direction. The void is possible flag of a trend change. Yeah, possible. I mean, the void creates the opportunity to move back up more easily. What we then have to see is, are failures taking place against that prior strength or weakness? Right? So it's those failures to move lower in this example that started to build the confidence of the bulls. The void is what created the opportunity for such a fluid move up. So climactic sell setup, right? Here we have on a 5-minute. Okay, let me go back 1 second. Go ahead. Yep. Right, we don't have any, the major resistance is all the way up here. So even as this did begin to move higher, we would not be thinking short. The M top. Right here, if it did an M top here, well, there's no resistance to the left, but if it did form an M top here, that is beginning to create resistance. Right? So if we saw that it started to do an M top here and the internals were bearish, then yeah, we could have been looking to short that. Right? Because it's the market's way of beginning to create new resistance. Well, yeah, Skibo was saying he's willing to short under this bar. Well, there is no resistance, that's true, but the breakout followed by an inside bar, if it breaks the low, sets up the possibility for a breakout bar failure in within this downtrend. So it is a valid setup to take. Right? It's not a PSS, but it sets up a potential breakout bar failure. Yeah, I would say it is a bit more aggressive after this move lower, but still a valid setup. I wouldn't say not to take it. If you're willing to, if it's part of your plan, I wouldn't tell you it's a bad setup. I mean, it does offer a relatively tight stop with pretty good reward down to the low. Yeah, just because of the base down here, the failures to move lower. I wouldn't be willing to take it, but a double top would be more interesting. Or if it came down here, right, if we got this wide range bar down, and then we just started to base out here, and it tried to move lower and failed, then I would absolutely be looking to short the breakdown. So whereas he may have been able to get in up here, I wanted to see that the extra weakness, and I'd be getting in down here. I noticed after new low reversals come with tick divergence, I get out right away. Absolutely, I agree. If you get a new low reversal and the tick is making a higher low, unless you have every other internal extremely bearish, odds are the market's going to retrace. Yeah, if we came down here and then we were to base out in the bottom portion of this area here, yeah, that makes it okay to short. Right? Because then, right, we had 100% retracement back down, but then we had a little resting period. This little stall here to short it. Yeah, this on a smaller time frame, this is a little area of consolidation. So yeah, I mean, like I said, it's okay to short it here. It is a bit more aggressive, but it's fine to short it here. Definitely something that if you were going to do, you want to make sure you have decisive internals. You want to make sure the odds are on your side. Now with these climactic sell setups, right, we want to see that there's an M top in a lower time frame. So here we have a move higher and things becoming a bit climactic. On the 5 minute, we're getting far away from the moving average, and momentum is beginning to slow. So instead of shorting on the 5 minute, we go down to the 2 minute, and here we have a little double top with a new high failure. It's then followed by a little inside bar. We break down, and that sets up the short to go against that or to go with that 5 minute climactic sell setup. So anytime we're looking at a climactic sell setup or buy setup, we want to see that the lower time frame has some type of retest, and ideally if we could get a failure, that's even better. Right? This made a little new high and came right back in. Right? That makes it even better because other traders got caught. But again, we do want to see that the shorter time frame has some type of retest pattern and failure. That is how you're going to align the odds much more in your favor. And then here we have down here, right, a wide range bar followed by an inside bar at a small area of support. So there's your warning sign that momentum now is beginning to slow. And on the 5 minute, we've pulled back into prior support. We're beginning to stabilize more significantly here, forming a PBS. So it's important also that with these counter trend trades, we don't stick around for very long. We have to put it in the context of the prior strength in this case, and understand that going against the trend, we're not looking for a home run. We're looking to pick up a couple points, a couple ticks, and then getting out. We're not looking for this to come crashing back down. We're not looking for this to become a home run. The home run trades come in the direction of the trend. After this wide range bar up, you got an inside bar, you buy it above the inside bar's high there with the bottoming tail. There's your nice clean fluid move. Yeah, and you have to have void to trade against the trend, absolutely. Yes, absolutely. Climactic buy setup with the W bottom in a lower time frame. Here we have an accelerated move to the downside, two bottoming tails side by side on the 5-minute. On the 2-minute, we have a bottoming tail. It then breaks down to a new low, another bottoming tail, and then this 2-minute bar closed up on its high. So there's the signal to go long. You've got the new low reversal, the potent bullish bar closing on its high. There's the signal to go long. We then begin to move higher, and we get a nice push up, and prices then pull back once again, and you get another 2-minute bar closing on its high. However, I personally probably would not have taken this 2-minute pattern. Why? Because at that point, we're up into an area where the 5-minute is going to likely see supply beginning to increase. So I wouldn't have taken that 2-minute pattern. Right? I would have been out up here as we came into that congestion. Right? I would have been looking to get out as we're coming up into this area of overlap. And then I reassess what's going on. Here we have the measured move setup. The move lower starts with a double top. The double top sends us back down, right? A nice fluid move down, which creates a void, right into prior support. We get buyers stepping up, and the changing of the guard fails. It's followed by a bearish reversal. Now this again based on this time frame looking at it, it is a more aggressive entry. But when we take this particular picture and combine it with the double top, and let's also say that the larger time frame was a PSS, this is a very good setup to take. Why? Because you expect failures at support given the larger time frame bias. So let's say this is a 5-minute. The 15-minute came down from a PSS. We're now at a little bit of support. We're looking for failures to set up here so we can get on board short looking for a move lower. So while it seems as though this may be an aggressive entry, you want to make sure that the larger time frame supports this action. So the fluid move, it comes down to support. It fails to move higher. Instead, we get an inside bar. We crack the low of the inside bar, and then we just go into management mode. Again, with this particular setup, we need to make sure that there's room to move lower as well. Look at another example. Here we have now a triple top. Market tried to go higher several times and failed. We get a nice fluid move down, indicating strong selling. Prices then begin to stabilize here. They come up and fail. Right? We get a changing of the guard here right up into this prior congestion. Right? So almost as if we have a retest pattern here, followed by a bearish reversal. We short under the bearish reversal bar's low, and then we track bar's highs. Okay, I'll wait for the question. No, it's not. You don't have to have, for the measured move, it doesn't have to have started from a double or triple top. It just so happens that with these examples, that is how it happened. Right? But even if we just got a fluid move down, right, and then it was failing here at that support, that is okay as well. Like it just so happened that we were able to find an example that had both. Again, here we have the opposite, right? Measured move to the upside. Here's a sharp fluid movement to the downside, which creates a void. We then get an equally strong move right back up. Penetrates deeply into this resistance area. We get a bearish changing of the guard. It's then followed by a little inside bar and bottoming tail, closing up near its high. So the entry is above the bottoming tail. And then, again, we just track prior bar's lows. Now, let me just ask you guys, what would this be? I mean, this move down followed by a move up on a larger time frame. What would this look like? Right, a breakdown failure, right? A shakeout, bottoming tail. It could be a PBS. We'd have to see what else is going on. But yeah, it would be a bottoming tail or a shakeout. Exactly. So that's why, like I said, we want to consult with the larger time frame as well, because when we can use the larger time frame's bias, right? If we didn't get on board this move up, right? Because this trend was down, and we didn't participate in this, we now know that the larger time frame is taking control. So we want to look for failures up here to be able to get on board. And so we enter above the bottoming tail, and then we just ride it up for profit. And then once we get this topping tail here closing on its low, that's where we begin to say, okay, momentum slowing, right? This move here created a void. So I would not be willing to sit through a pullback. Why? Because this move up creates a void. I'm not going to take the chance and let the market begin to pull back and try and find out if it's going to create support. I'm not willing to do that. So I'll take profit if we break below that bar's low. And as we begin to pull back, I'll just look to see, are we creating support? If so, I'll re-enter. But I'm not going to let this pull all the way back in and leave my stop down here to see if the market's going to stabilize at some point. That's me. Breakout with a prior shakeout. So prior to prices breaking out, what happened here to the left was an attempt to move lower that failed, and we came right back up into the breakdown area, started to consolidate once again, building the confidence of the bulls. So prices were moving lower. The larger time frame may be in an uptrend, so this may just be forming a PBS. This failed attempt to move down begins to build confidence back up. We begin to see bearish bars having no follow-through, and we get a potent 180 reversal. Right? So we buy the breakout above these highs. Prices then chop around a little bit. They then break higher once again. So if we got wiggled out, or if we didn't get in, here's the next spot to get on board. Little consolidation bar here. This is essentially our 1, 2, 3 continuation pattern now. Right? We are in an uptrend, breakout, followed by an inside bar. Yeah, you could call it an inverse head and shoulders. Right? It's the same thing. Again, I don't really care what you call it, as long as you understand what the message is. Right? The message in this pattern is that demand is increasing. Here we have just the opposite. We have prior weakness. Prices begin to retrace. They break out right into major resistance. It fails. It comes right back in. Starts to consolidate again. We start to get topping tails here. Supply is increasing. We break lower. Right? We can short it under this topping tail bar's low. On the breakdown, we short on the breakdown. This move here, this green bar up and then potent reversal back down, as it says here on a lower time frame, we would have a PSS. It would have been several bars moving up into resistance with some form of a changing of the guard and a transition back down. So that's why we look at multiple time frames, so we can see what's going on within multiple time frames. We can see how the market's operating in different time frames. And then we again just go into our management rules. But some of the main things, some of the most valuable information is again going to be from signs of no follow-through. This bullish bar having no follow-through. This bottoming tail having no follow-through. This bar closing on its high, which we know set up a PSS on the smaller time frame, having no follow-through, also tells us how strong sellers are. So it's important that we take each bar's message and then we continue to say, okay, well, does it have any follow-through? Breakdown with a wide range bar. The overall trend is weak. Right? It's sideways, but it's still weak. We can see that it's red to yellow, back down to red. It came from a higher area. So overall, while going sideways, the bias is still bearish. This breakout results in a topping tail that closed on its low. Very strong signal that we're going to begin moving lower. So this wide range bar breaks down, it closes below the base. Shorting below the wide range bar is okay. We could short under this wide range bar's low. But what would be better would be a 1, 2, 3 continuation down or a minor little PSS, which then set up a lower high for us to get on board. Okay? Really what we're looking for is any confirming pattern to this wide range bar igniting. And then, of course, there's no way to know how prices are going to follow through. And then we just, again, manage that position. As it says here, this topping tail offered a secondary entry. This was like our measured move. Right? We get a move down. We don't have any support to the left, but buyers try and step up here where there's no support. Attempts to move higher, and it fails. Instead, it gets reversed, topping tail closed on its low. So there's another opportunity to short. This topping tail, secondary entry, could lead to a new low reversal. It could. It could. But one of the things that I want you to recognize also is that this is a bit different. Right? Of course it could happen, but this is a bit different a situation than the one we were looking at earlier that we were discussing. Why? Because the one earlier that we were discussing happened after a climactic move lower already. So prices had already moved lower. With this example, we're getting a wide range bar after a period of consolidation. Right, this is coming from a base. So it's less likely, but of course it's possible. But that is the nuance that we need to be aware of when comparing this wide range bar to the one we were discussing earlier. No problem. Good question. Triple top. We already looked at this example once. Not this particular one, but an example of a triple top. 3 attempts to push up and no follow through. Every attempt to move higher is met with selling. strong indication that supply is increasing. Maybe the larger time frame is setting up a PSS. We'd have to consult with it. But as we break lower, we do not want to just short the breakdown here because it's a greater than 100% retracement. So we wait for the retracement to happen. We wait for the next lower high. Prices stall here, come back up, we get a bearish reversal. Here's the high odds shorting opportunity. Right? If we didn't short the triple top, this is another alternate entry. This last point, as I said, if the larger time frame is in a downtrend, will increase the odds of this working out. Or if we have a pivot line up here, that too will increase the odds of it working out. Triple bottom, right? Same concept. 3 pushes lower that fail. If in a downtrend, the market or the contract that we're trading cannot break lower after 3 pushes, odds are we're going to move up in the opposite direction. So as you can see, we've got 3 pushes here. Maybe the larger time frame again was in an uptrend. Maybe we had a pivot line here. Those will help to increase the odds of this play. But on the third attempt down here, and we getting a bullish reversal, that sets up a long. And then as this comes up and we get no follow through here to these bearish bars and to these topping tails, it's followed by a potent reversal closing on its high. This provides another opportunity to get long. And then we just see what happens next. We go bar by bar, looking to see whether or not our prior analysis is being confirmed. Now, another setup that we'll look to take advantage of is the tick fade. Right? It's best used in a sideways trend, right? When the market's just going sideways and there's really not a whole lot going on in terms of a trend, we want to look to fade the tick. So as price runs up into resistance here, we get a retest of this prior high and an inside bar, right, after the retest. The tick pushes up to an extreme. So we can short under that inside bar's low because we were getting a slowing in momentum. The move up created a minor little void. We already established that we're in a sideways trend, so we have a clear reference point of support and a clear reference point of resistance defined. So we get the retest, inside bar, ticks went to an extreme, short the low of the inside bar, looking for a quick move back down towards the bottom of support. Now again, this is a very short-term scalping setup. You short under the range, under the bottoming tail. It's a very short-term scalp setup, and we're just looking to cover at price support or tick support, whichever comes first. Right? And like I said, I mean, this is just scalping. This is not trading within a trend. This is just taking advantage of short-term momentum shifts. That's it. The first entry is here on this bullish reversal, right, on the third attempt to move lower that failed. And then the second one is right here where we've got this bar closing on its high, buying the breakout. That signals the next spot to get on board. Yep, I'll wait. That's right. It is 100% retracement. But what happened here? Right? What happened here as we came up to do this 100% retracement? What happened here that makes it okay? Exactly. It based sideways, so it absorbed that resistance to the left. And that's what makes it okay to buy this breakout. And it didn't just run all the way up to the high and then continue to go. I would not have played that. Right? Similar to what happened here. Right? This one, after the second retest, it ran all the way up and took out that prior high. You can see that it traded right up above that high, right, by a little poke. I wouldn't have been buying that because it was from the bottom and it never did base. But this one came up and started to consolidate sideways. We had no follow through to this bearish bar. There were two topping tails that had no follow through. And then we closed on our high here. Right? When the tails go away, it's time to play. Right? That's the saying that we use. So, to recap, we're going to take trades in the direction of the 5-minute trend. The 5-minute, right, may or may not provide the signals. It's not necessary, right? We're using the 5-minute for the trend. If it sets up a pattern for us, then great. If not, we're also using the shorter time frames to get on board signals as well. Once the 5 minutes trending, it's okay to take signals from any time frame below it. Right? We're trading in the direction of the 5-minute trend, and once we've established what that direction is, we can go down to the shorter time frames looking for pullbacks to support and for those pullbacks to stabilize and then result in another move higher if it's in an uptrend. The only exception is the morning gap, right? Because we're using the pre-market trend as well. Well, not so much the end of the day. I continue to use the same rules for the end of the day. The only exception, like I said, is for the opening gap. Okay, we're going to use the pre-market trend as well because at the open, we don't have any real information about the new day to make decisions based on. Right? We don't have a strong trend one way or another, so we use the pre-market trend to help guide the bias. Right? But then in the end of the day, I'm using the information from earlier in the afternoon, and I'm using my support and resistance guidelines. If we had a move lower and then a double bottom was forming, as long as we have void to move higher and potent reversals on both sides of the W formation, we better be looking to take it long. Right? If we can add to that a pivot line and support to the left, it's even better. Yes, if the 5 minutes going sideways for extended periods of time, you can go to the larger time frame, the 15-minute, the 60-minute, to get a longer-term direction for trend. Absolutely. We also want to look for shocks or failures. This is going to increase the odds of follow-through to signal. So, if we can get a breakdown in an uptrend, a breakdown failure in an uptrend, that's going to increase the odds of follow-through to the upside. And like I said, anytime we can add pivot lines, it's going to increase reliability because it's going to have more traders looking to take action in that area. Give examples of common mistakes traders make. One of the biggest things I think probably the biggest mistake or struggle is that traders try and trade every time frame. They try and trade the trend from every time frame rather than saying, this is my rule, right? I'm going to use the 5-minute for trend, and once I establish the direction of the trend, I will take setups from that 5-minute or any time frame lower. So many times traders get confused. They want to buy a 5-minute PBS and short a 1-minute sell setup, and then the 15 minutes maybe going sideways, and they just totally confuse themselves. So the biggest mistake that's made is not being able to clearly define what the direction of the trend is. And that's because they don't have a rule that says where they're going to get their bias from. I mean, going through the seminar here so far, we're putting out a very clear, concise trading plan. I mean, this is how we want trading to be. As we go through the seminar, it sounds simple enough. But what makes it so difficult is what's between our two ears. Right? We begin thinking too much. We see signals from the 2-minute that maybe get us a little on edge about whether or not the market's going to be able to move higher. We don't. Who are we to try and anticipate where the market's going to go? Who knows? We don't know. Nobody knows from 1 minute to the next. Well, in terms of targets, for you don't want to use a set number of points. Right? I mean, we have to have a max loss per trade. Right? That we have to have, and we're going to talk a little bit about that in the last section today. But we have to have a max loss per trade. Right? Whatever that is, it's going to be different for each of us, and that's fine. But we have to have a max loss. That's going to tell us how much we can lose per trade. That's going to be the starting point. Right? In terms of targets, we don't want to use, as I said, a set number of points. Right? We want to let the market tell us where our targets should be. Targets are going to be based on price void, support, and resistance. That's what determines where our targets are going to be. It's not going to be, okay, I'm just looking to get 15 ticks and get out. Because 15 ticks, that's great. But 15 ticks may be only half of the void up that exists. You may be shorting yourself from an entire another 15 ticks. So don't use points as targets. The market will tell us where we should have our targets set. For an example of a double bottom, and I'll see if I can find one here, but we really haven't seen very many lately because the market's really just been sideways. But here's kind of that general idea. It's not perfect, but the idea, right? Here we have a potent bullish reversal on the left side of this chart. No follow through to this bearish bar. We move up, come back down, retesting this low. Bearish bar followed immediately by a bullish reversal which closed over 60% into that prior red bar. Right? So you've got your two potent reversals on both sides, and it results in a very strong move higher. Right? This red bar said we were going down. Very next bar completely reverses it, shocking those traders that were short within this red bar. All right? Trading day prep. these are the last two sections, so they're a bit more relaxed. They're not as challenging. It's really just talking now about how we're going to get ready for the day, and then the next section is money management and some just some general thoughts on proper psychology or mental wellness. So before the open of every day, we need to check the economic reports. Right? We don't want to get caught in a situation where come 10 o'clock, we're in a position and unaware that there's a news release coming out, and the market just takes off against us. And we get caught in this position unaware that there was a report coming out. So we need to have a source from where we're going to get the economic reports for the day. And then we need to be aware of course, the time of day, right? We need to make sure that we know, okay, 10 o'clock I have consumer sentiment coming out. We need to check the buy and sell values, the program trading buy and sell values, and set the alerts. We need to set any alerts based on prior highs and lows, right, or retracement levels. Review the daily pattern as well as areas of support and resistance for the various indices and mark them off. And we also want to review the market internals for short-term as well as intermediate-term indications. Right? Where do we see the markets are likely to go over the next couple days and even further out from there? So we're going to get, and I'll post the link for this Econo Day website, but this is where I get my economic reports for each day. This is where I reference, this is my reference for where or when these economic reports are being released. And like I said, I'll post that. Just unless any of you guys have the link handy, you can post it now. But if not, I'll post it at the end of this section. We also need to get, as I said, the program trading levels, the buy and sell levels, and then we input those into our scripts. As I said, we look at the end of day internals, which again you're going to review with Greg. But on this particular day, or looking at these end of day internals, the markets, and it's kind of tight here, but you can see in your manual that we've got a pullback here in the market. It's been a deep retracement, but it is at support, and we've got several market internals which are either into oversold levels or neutral areas. Thank you, Cole. So that's the link right there for the economic reports each week. But looking at these end-of-day internals, they're set up for a stabilization in the market and a retracement back up. So over the next couple days, I'll be looking for the markets to stabilize and then begin to move higher off of the support that they've retraced into. We need to review the daily chart, as I said, for various reference points. We look for prior price pivot highs or lows, and we mark them off. We look at the most commonly followed moving averages, the 20, right? The 200, even those that are going to be looking at the 40 or the 50, right? We want to look and see where those are on the daily chart, because we want to know where traders are going to be acting. Right? If we're coming into a 20-period moving average, right, pulling back into a 20 MA, then we know that there are going to be groups of traders that are going to be looking and thinking to get long. We then want to move to the longer-term intraday charts, those being the 180 and the 60-minute charts. we look at those areas for supply and demand. Is it tight or is it loose? How far away is it? Do we have a void? Is there a trend or are we just going sideways? We go to the 5 and 15-minute charts. We ask the same questions. Is there an end of day rally or an end of day base? If we're gapping above that base, it's going to be support. If we're gapping below it, it'll be resistance. Right? The end of day rally or decline leaves void up or down. So then we use all this information to form a bias for the following day. And we also want to ask ourselves, and this is an important one, what would have to happen to change the overall assessment that we just did? The reason we want to ask ourselves this question is because as much analysis as we do, and as likely as it seems the market may move in one direction, we have to be prepared for the opposite to happen as well. Right? If we're not aware or prepared for the opposite to possibly happen, if it was to take place, we wouldn't know how to respond to it. So we want to be aware of both directions, right? Even though one direction may seem more likely than another. So here we have the daily in the upper left, 180-minute in the lower left, 60-minute the lower right, and the 15-minute in the upper right. So on the daily chart, we're up several days, but there's no resistance to the left. And we're up several days, and it has been a greater than 100% retracement. So what do we expect may happen after a greater than 100% retracement? After a greater than 100% retracement to the upside, right, where ultimately, yes, we do expect that it will continue to go up, but it's likely going to stall and pull back first, right? So here we have a situation where on the daily, it's up several days and it's a greater than 100% retracement, right? And it does have room to move higher. So ideally, it'll stall here, maybe pull back, and that's where we want to be looking to get long. The 180-minute chart, several days up, and it's now beginning to break out here. So buyers are stepping up. They were stepping up into the end of this day. The 60-minute, we see bearish bars being ignored, and we're beginning to move higher here again. You can see the 60-minute beginning to break higher. The 15-minute is a wide range bar after a decent move higher. So this creates an end of day rally, right, leaving void below. So again, prices have room to move higher, but they're likely to retrace or stall. So we want to be buying at support. Support is at the top of the base, right, which we've established here on the 180-minute, the 60-minute. So if prices move below that area, if they move under the bottom of this range, we're going to then have a short bias. So while that short bias may seem unlikely, we have to be aware of what may happen, because if we do move under this bottom here, there's room to drop. I do, Tom, yes. But again, remember, this analysis is done before the open begins. So I'm not doing this right in the heat of battle. I'm looking to see before we open, how are things setting up? We want to do this pre-market review to see, okay, this is what we should be thinking based on the information of the prior day. And then we look at also the pre-market trends to see whether or not that's confirming or not. what we're going to do here on the next couple slides is start from the daily and work our way down. So starting with the daily, this short move lower and greater than 100% retracement, it creates a void back up. So the move down is bearish, but it doesn't mean that we can't begin to retrace back up in the short term. Right? The large drop actually, like I said, creates the void and the potential for that move or for that advance back up. So the intraday patterns are going to give us an indication of whether or not that's actually possible. So we drop down to the 60-minute. Right? And again, like I said, we're just dropping down each time frame. So now what we see here, this 60-minute move is that wide range bar down on the daily. As you can see, we then went into a trading range here. We began to try and create resistance. But we gapped up. So this end of day or this multi-day base, right, once we gapped up, created this now as support. Prices pulled back, they stabilized, bottoming tail here, right, into the top of support, and then we began to move higher into the void. Right? There was no reference points to stop prices from moving higher. They continued to move up until they reached the next point of resistance, which was all the way up here. So based on the 60-minute, right, there were signals here to get on board. But the 15-minute, or rather the 5-minute, can provide us with even greater insight. So here, this 5-minute end-of-day rally was the move to the top of that 60-minute base. Right, let me go back for a moment. This end-of-day move up here, right, was the move up towards the top of this base. Right? This one bar up is several bars moving higher on the 5. Right? Then we get the bullish gap up, which creates a void back down, but we have to remember that on the 60-minute, we were gapping above a significant area of support now, or what became support. So while this did create a void, and there was the potential for this to move lower, buyers continued to step up. And then we got this breakdown failure right here. That was a strong indication buyers are now stepping up and taking control. We then get a little push up. It comes all the way back down. Right? We get this shakeout pattern. And then prices go sideways again. They finally begin to advance right around just after 11 o'clock. Why did it take so long for the market to finally begin moving higher? Because of this end-of-day rally. Right? The end-of-day rally and then gap higher, right? When that is the situation that we're confronted with, a lot of times that is not going to lead to immediate follow-through. Right? As it says here, if the 5-minute had been an end-of-day base and then we gapped up, it would have been much greater odds of immediate follow-through. But because it was an end-of-day rally and then we gapped higher, a lot of times what we'll find is the market needs to create support here and go sideways. So the first entry point right here, right, this was along right here, this bottoming tail. Right, then we retrace deeply, shakeout. Right here was another entry. Right, buying this breakout. Right, didn't really result in much, but that was another spot to get on board. Prices then pull back. We get another little double bottom here. And all the while, again, remember, we'd be looking at the internals. The bias from the larger time frame, we're thinking bullish. So based on that information, we're expecting bearish bars to have no follow-through. Right? So that double bottom provides another possible entry. The breakout over here is another entry. And even this breakout here is signaling that buyers are now stepping up more aggressively. So there were a couple entries that would have developed here, right? But again, the market really didn't start moving higher until just after 11 o'clock because it had some work to do. It had to create some support after that end of day rally. So here we are back to a daily chart. The daily time frame we're going to use, as we said, for our longer term bias. It may or may not follow through. Right? It gives us a longer term bias, but again, we have to look to the intraday charts to see whether or not we're actually getting confirmation. So this is Tuesday's bar, right? Let me go back here. Here's Tuesday, the 21st. Right? It's this down bar, right, which indicated weakness. But on the following day, the 22nd, right, we got a bullish bar right back up. So again, we're going to go down to the 5-minute, and here is the decline from Tuesday morning. Right? Fluid movement to the downside, retracement. Here we create a double top, which provides a shorting opportunity. Right? Shorting the break here. We get a move lower, and then an end of day base. Right? So as we base sideways here, we have a void above. This void above is created as we move sideways through time away from that prior congestion. On the 60-minute 24-hour chart, right, these starred points represent the same top and the same bottom as we just looked at on the 5-minute. Right? But here is the 24-hour chart. So this was the move lower on Tuesday. Pre-market, market's just quiet, it's going sideways. It then begins to move lower. Right? 6 in the morning, we get a very potent bullish reversal back up. The market then begins to move higher. At the open, right, we're already opening at the very top, right, or actually just above the top of that end of day base. So that's bullish. Right? Then we just look to enter from a lower time frame, right, because we know that there's void above. So again, while the daily said to us, okay, going into the following day, it's looking like we're going to follow through to the downside, it doesn't necessarily have to happen. Right? That's why we have to be aware of both scenarios. Because as we began to move up at 6 in the morning, and once we entered into this void shortly after the open, the odds for this to move higher and fill that void were very good. Yeah, FOMC was pretty wild. Right? But that's what the analysis has to be. Right? Don't get stuck in the bias that says, okay, here's a fluid move down, we're going sideways, the daily closed bearish, we have to move lower. Right? Don't ever say we have to move lower or we have to move higher. Right? We don't have to do anything. We say odds are likely that the market will move lower. However, if we move up above the end of day base from yesterday, there's the opportunity for a complete retracement back up because of the void which was created. And that's exactly what happened. I have not, no. But, I mean, as long as you can chart it, it's going to work. Why? Because why does this method work so well? Because it's based on human emotion. It doesn't matter what market you're trading. As long as humans are trading it, it's going to provide the same opportunity. As long as people are trading that market, as long as we can see the candles as they're forming, we can read the emotions of those traders that are creating them. And that's the beauty of this method. Maybe. Yeah, the internals. You know, they could definitely help to put the odds in our favor for sure. Absolutely. All right, guys. Well, let's take a quick 5-minute break here, and then we'll wrap things up with mindset and money management. All right, so take